Okay, so welcome to class today. So in today's class, we'll be looking at a new topic, which is called sensitivity analysis. I'm going to put it here, sensitivity analysis using an important tool called the data table. So in our last class, we were able to use the data table to prepare an amortization table, which has to do with where you're calculating loan repayment schedule. Okay, and I believe we're able to get acquainted with some of the basic aspects as it relates to that. So in today's class, we'll be looking at how we can be able to use same data table to perform a sensitivity analysis here in Excel. So it's very important that you're able to do that, because if you're not able to do that, then the aim of this program is not yet actualized. So it's very important that that is done. So normally, like I said, that a financial model is basically a great way to assess the performance of a business, most especially when you're looking at the historical or let me say projected basis, which is very important. So it's a good way in which, when you're like performing the role of an analyst, it helps you to be able to organize a business operations and also to be able to analyze the results in both a time series format. Okay, and that's just what the sensitivity analysis is all about. It ensures that you're able to measure the company's performance against itself over time. And it's very important that you're able to do that. So once you impute both historical and financial results, or you come up with assumptions about future performance. And then when it comes with assumptions about future performance, that's also one aspect where what we call scenario analysis or scenario manager also comes in. We'll look at that. But if we're not able to look at that today, in one of our classes, we are going to look into that. So all I'm saying is that you should be able to calculate and interpret analysis and also other operational performance metrics. And in today's class, we'll be looking at some little problems, okay, majorly profit or loss. We'll be looking at the income statement, okay, so we can, get to see how be able to do this. So I made mention of the scenario manager. It's very important because it allows you to be able to analyze financial results or forecast, okay, based on your expectation. So if it was to be the scenario manager, same way you have to come to the data tab, you come also to the what if analysis section, you will see where we have the scenario manager. It helps you create different scenarios. Okay, for example, if we have particular informations line up where we said for the month of this month, we are trying to prepare a forecast to know, okay, if we sold, let's say we sold 200, let's say we have our quantity here. Okay, we have our quantity for this month, quantity sold. Let's say quantity sold gives us 2,000. Okay, and when we sell 2,000 quantity, we make a profit of 5,000. Okay, now this is basically a scenario on its own. Okay, it's basically a scenario on its own, meaning that at 2,000 quantity, if we sell 2,000 quantity, what we'll make is 5,000. So the scenario manager helps you to be able to come up with such kind of, a forecast or analysis that helps you to arrive, okay, at a certain conclusion, and it helps you to also be able to compare results where you have looked into different features. So I can decide to add that scenario by clicking here on add, then I give it a name. I can say when 2,000 quantity is sold. Are you with me? When 2,000 quantity is sold. Let me just show you what I mean by this quickly. Now, what I mean is this. If we are saying for quantity sold 2,000, Okay. Okay. Now we can basically, before you're performing such kind of tasks, you should have ensured that the whole information provided is being linked up properly. But I'm just going to try to see how we can do this basically. So let's say this is our quantity. This is our quantity. So let's just say this is our quantity sold. Okay. And this is our selling price. So let's say this is our selling price. This is our selling price. And then let's say, okay, we have our quantity sold, we have our selling price. We should just ignore that of products. So this should be just for product A. Let's say this is for our product A. Okay, product. We say this for product A. Okay. Now, what becomes our revenue? We have quantity sold. We have selling price. So let's say this is our revenue. Okay, I know revenue is going to be our quantity sold times
The
our
selling
selling
price.
price.
Selling price.
Selling price. So I can just do this way. Okay, and you can see we are having this
10 million.
quantity sold. I can reduce it to 500 quantity. Okay, so we're having this, which I can put it.
2.5 million.
Yes, good, 2.5 million. So now this is a scenario on its own. You can see this is just scenario one. This scenario one. Scenario one. This scenario one. Now, in scenario one, we say that if product A, for product A is our target, if 500 quantity is sold for this month, which we are in October, okay, for this month of October, if 500 quantity is sold, we will arrive at a revenue of how much?
Of 2.5 million.
5 million. Now, what if 1,000 quantity is sold? Or even, let me change this to 200 quantity. We arrive at 1 million. What if 500 quantity is sold? 1,000 quantity is sold, and so on. You use the scenario manager to be able to forecast that and prepare it so you can be able to view that at all time as your company's operation and every activity, financial activity continues. So what do I do at this point? I have to come to my data tab, come to what if analysis, scroll down to where I have the scenario manager, add. I say this is scenario one. Okay, and so this is scenario one or forecast one. And so this is forecast one. This forecast one. Changing sales. Changing sales is the quantity sold sell. So that's what I'm going to select. Okay, and I enter. Okay. So now once I've done that, I will then do what? I click on OK. Now enter values for each changing cell. Okay. And the first value we have is how much? 200.
200.
So I just say OK. I've just added forecast one. Now I also go and add forecast two. Okay, for forecast two, I also say this for our sales forecast, sales or revenue forecast, and say revenue. Okay, let me just use sales forecast two. Changing sales, same cell. I say okay. On what will be in the changing cells? Let's say at 500. Then I say what? Okay. I've added forecast one, sales forecast one. I've added, and you can edit it. I can add sales since I didn't add sales there before. Okay, and say okay. Still that. So I've added sales forecast one, and I've also added sales forecast two. Let me say I also want to add sales forecast three. This is sales forecast three. Changing sales is still the quantity sold sell. Then I say okay. Then I say at when 800 quantity is sold. I say, okay. So this is how you can add as many as possible. Okay. So once you're done with this, you then click on what? Show. Hope you're with me. Provided you've ensured that every information has been entered properly, you then click on show, and it's going to take you to that very aspect. You'll be able to see that. But if you don't want to do that, instead, what you're going to do, click on summary. Okay, click on summary. It's going to show you these two report formats where we have scenario summary and scenario pivot table reports. So if I select the first one, scenario summary, and I said okay, you're going to see it on a new sheet. It brings out the summary for me, where I'm going to see where we have, what do you see here? Scenario summary. We have current value. The current value was 200. Okay, so at 200, we are going to make, if 200 quantity is sold, we are going to make a revenue of
1 million.
Now, for the sales forecast 2, I also use 200. And sales forecast 1, this was current value. So we start from sales forecast 1. For the sales forecast 1, we say 200, 1 million, 500, 2.5,
2.5.
4 million.
It's 4 million.
So you can see that this gives you, makes it easier for you to be able to compare, okay? It helps you do your comparisons, to test for different options or different quantity. So you can come in here, since we know this is quantity, okay? You can come in here and I can say, I use control 1, okay? Right here, I want to change this to quantity. So I can use control 1 and it brings this up. I come to custom. Okay, then I clean this. I clean what we have here. If I want to clean that information, I can clean it and say, let this be quantity. Okay, I say quantity. So but if it does not change for you, you can as well come over here. Here we have C6, we called it the name box. So you can also come over there and change it to quantity, enter. So it's supposed to change, or you can also do it here depending on what you actually have over there. So I can say this is also our quantity depending on what you're using. This is our revenue. So it's also important that you change it from the name box too, because if I come here, name box will also reflect it as quantity, and it's very important. So I will come here too and say this is our revenue. So you can see that this is also very important. And one of the importance of this is that it allows you to do a kind of carry out a test, to test the financial result, because the reality is that expectations can and usually do change over time. Okay, there are possibilities, okay, which can change. For example, when we look into budget, we have overheads, which there are possibility that they are not fixed costs, that's sure, and there are possibility that prices might change. For example, it could be fuel, for things like fueling. Tomorrow price might change, is that. So you're expected to be able to use the scenario manager to be able to do your comparisons. Okay, to be able to do your comparison, because the future cannot be predicted with any certainty, and it's never a good idea to take your financial models results and claim either to your boss or to your client that the results are final. The result cannot be final. So what if 200 is what we're able to sell? What should we be expecting? 1 million. What if 500? What should we be expecting? 2.5. What if 800? What should we be expecting? 4 million. So the scenario manager helps you to be able to do this. So it's very important. And very important here. And this all has to do with the purpose of the financial model, which is to provide some insight into future performance. But like I said, there is no one correct answer. So clients and managing directors, what they want to see is a range of possible outcomes. And this is where sensitivity analysis, or what we call what if analysis, comes to play. So at this juncture, we'll be going back and look at our class for today, which we'll be looking at vividly on what is called the sensitivity analysis. And right here, we have just done an intro using Scenario Manager, and you can always use this for a lot of things you want to do. But our major focus for tonight is sensitivity analysis with the aid of what we call the data table. Don't forget, as for goal seek, I've told you that goal seek works also here perfectly, ensuring that you're able to meet up with your target. And if it was goal seek, right here, our target was what? 200,000, and we have 164,800. Now you can come in here and put as many options as possible. You can say, what if we sell 50,000? Are we going to meet up with our target of 200,000? You can see no. So instead of wasting time and just suggesting, you can just also come to your data tab, and you come over to where we have you can come over to where we have the what if analysis. You can come over to the what if analysis section Okay, and then you do what? You select this very option called you go seek. Now set cell, set cell. We know the particular cell that we are looking at. So what is that cell? This is it, the contribution cell. Okay. Then the to value is what's the target. That's where you put the target. We say the target is what 200,000. So we can just put it there. The value 200,000. Now changing cell. The changing cell was that cell where we will put under assumption and trying to forecast what should be. So it is going to be the sales cell. So once you're done with that, you click on OK, and goal seek here is going to calculate it for you, and you can see actually that the target was met, telling us that for us to be able to meet up with this target of 200,000, that we must first be able to make sales of women's shoes worth 880,000
thousand.
naira. And that's just how it works. So at this point, let's look at the sensitivity analysis. So basically, the sensitivity analysis here is just one of the, it has to do with the what we call the what if analysis. And like I said, it works with that of the data table, which we have done before. Okay, so it's a powerful Excel function that allows you, as a user, to be able to view, the desired result of a financial model. And we're going to try to come up with a simple income statement financial model. So it helps you to be able to come up, with your desired result of a financial model, under different circumstances. Let me just say under different circumstances. So it allows you as an accountant to select two variables. Now, when we talk about two variables, we are now talking about what we call the two input data table. So where you're selecting just one variable, we mean one data and one input data table. But when it has to do with two variables, then know that what you should be looking at is the two input data table. I'm going to differentiate it properly in today's class for you, so you'll be able to understand that very one perfectly. So and also in the model, you'll be able to see the desired outputs, okay, which let's just start that so we can be able to get to see that. So most times I prefer that to the scenario manager, okay. So I prefer to the scenario manager, because it adds even more flexibility to your financial and your valuation models when it comes to analysis and presentation. So let's see how we'll be able to do that. So before we look into how to build the data table for the one input and the two inputs, let's say, for example, that we have a particular information. Okay, so we can come in here. We can come in here to this sheet. Let me rename this sheet to our sensitivity analysis. Okay, so right here we say, let's say we have our income statement. Let's just do a little more there. Income statement. Okay. I believe you can see my screen. Let me zoom this. Hello. Okay. So can you see my screen, Ma?
Yes, I can.
Okay, so we say we have our income statement.
Income statement.
Okay, so for our income statements, let's also say we have some information. So with this information now, let's say for example, this is the income statement. We have our units. Let's say we have our units. We have our units information for our units sold. Okay, this income statement for W and Z Limited. The W and Z Limited income statement. W and Z Nigeria Limited income statement. W and Z Nigeria Limited income statement. Okay. So our unit sold, let's say our unit sold is 15,000. Let's say it's 15,000. Okay, our unit sold is 15,000. This 150,000. Right, so these are our units sold, 15,000. Let's say we have our price per unit. So this is our price. Okay, this is our price, our selling price. This is our selling price per unit. Our selling price per unit is 105. Let's say 105.89. Okay. Let's say we also have our production costs per unit. Production costs per unit given as 48.05. Okay. Let's also say we have some costs, some fixed costs, which we could say we have costs like accounting software. Okay, accounting software subscription fee. Okay, accounting software subscription fee is given at let's just say we are using 27,000. Okay, for standard package. Okay, then let's say we have internet service, another fixed cost, internet service. And we say our internet service it's 25,000. Maybe we're using SpectraNet. Let's add more to information like our payroll expenses. Okay, could be our salary, and we can just use payroll expenses. So our payroll expenses, it's let's say it's 210,000. Maybe we're a small business, 210,000. Then let's also say we are having lastly postage delivery. Okay, our postage delivery, it's 20,000. All right, so let's just work with this simple model here. Let's work with this simple model here. All right, I believe you can still hear me. No, we'll soon be done. We'll soon be done. Hello. Okay, so let's prepare our profit and loss here. So this is our profit and loss. Okay, this is our profit and loss accounts here. So for this, first of all, let's look at our income. So for our income is going to be our units sold multiplied by our units sold multiplied by our selling price per unit. These are our units sold times our selling price per unit, which is this. Okay, can put our comma. Then we'll also calculate our cost of sales. So our cost of sales here is going to be our units sold. Okay, our units sold multiplied by our production cost per unit, multiplied by our production cost per unit, which is this. So I can also put the comma there. Then we also have the gross profit. Our gross profit is going to be our revenue, which is our income here, minus our cost of sales. So say this minus our gross income minus our cost of sales, and this is it. So also calculate our fixed cost. So our fixed cost is going to be that of all the costs that we have here from this. Okay, so I can just put it down. Accounting software subscription fee to postage delivery. Okay, so you can see it's showing me value. Now, hello. Hello, can you hear me? Okay. So I say these are fixed costs, and we're going to use our sum. Since that was not captured before. So you can see that our fixed cost is also given at 282,000. So lastly, we're going to calculate the net profit. So our net profit is going to be our gross profit, okay, minus our fixed cost. So it's going to be our gross profit minus our fixed cost, which is going to give us 585,600 as our net profit. So, ladies and gentlemen, it's just a simple model for us here to see. And we are just using this example to be able to look into this model in this very aspects here, which is important. So we had to build this simple dynamic financial statements, income statements model in order to be able to predict or to the future, okay, our future net profit here. So we can be able to come up with what we want to do. Okay, so we are going to present this information, and we should be able to ensure that we are able to come up with our results. And what we are going to do here in sensitivity analysis is that we are going to create a data table. And the data table is an effective and easy way to present valuable financial information either to your boss or to your clients, as it provides a range of possible outcomes for a particular piece of information. So let's see how we get started with this. Now I can come over here, okay, to say that if at looking at the selling price, we at this selling price per unit, we made a net profit of 585,600 because there is a relationship here between the selling price and that of the net profit. If I should change this selling price to 200, then it is going to change our net profit. It's going to increase. So I could say I want to carry out the sensitivity analysis based on our selling price. So what am I going to do at this point? I will come over here and say, let this be our selling price. I say selling price. So now I want to carry out what is known as the one input data table to be able to carry out this analysis. So what I'm going to do, I'm going to bring down our various the various prices I want to look at. Let's say I want to look at a price like, let's say 89.20, okay, let's say 94.20, okay, let's say 99.20, let's say I'm also looking at, okay, or let me say I'm looking at 105.89, okay, 105.89, and let it be 109, 109.82, let this be 111.23 selling price, let this be 114.22, let this be 116.02. Let's say we have a selling price of 118, okay, 0.2. So we can do that as many as we want. Okay, so that's just selling prices that we have. Now we want to calculate it based on the net profit using the input data table. And like I said, that the data table is an effective way and easy way for us to be able to present valuable financial information to our clients, as it provides us with a range of possible outcomes for a particular piece of information, which at this point, these are the particular piece of information where we can highlight the net profit. So we want to know, assuming the price, selling price per unit was 109.82, what will be our net profit? If the selling price was actually 118.2, what would be our net profit? Now to do that, first of all, we are going to come over here and highlight our net profit, which is what we are targeting. So we'll say net profit equal to net profit, and we'll say enter. So we have just captured that information. So same procedure, you have to highlight this box. After highlighting it, what do? You have to proceed immediately to the data tab. When you get to the data tab, you come to what if analysis, then you say data table, the third option there. Now, when you're using the one input data table, you're only going to input on one box here, and this required field, okay, which is going to be the column input cell. So what am I going to? I'm going to ignore the row input cell because at this point, it's just one variable, which is net profit. We're only looking at the net profit. We want to know what net profit we are going to arrive at if these prices were to be sold. Okay, so that becomes just one variable because that's just the one aspect we are looking at. That's why we highlighted it here. So what are we going to capture under the column input cell? Is going to be the selling price per unit. So I'll go there and put in the selling price. While do it this way, so this is it, the selling price per unit. Okay, then I enter it. I say okay. So you can see right here, the information is now what provided, telling us that if assuming we worked with this selling price per unit of 105.89, it will still be the same 585,600 net profit. But if there was a change in our price, we are going to generate that of 644,550. So this is just how the one input data. Okay, so this is it using the one input data table to do this. So now let's also look for the let's use the gross profit. Let's say we want to know how much will our gross profit be, assuming there was slight changes also on the respective selling price per unit. What are we going to do at that point? Same way, first of all, let me just highlight this and make it look bold. Let me highlight it and make it look bold. So same way, what I'm going to do is I'm going to come over here and say equal to our gross profit, which is this. Okay, our gross profit. I say enter. So once I say enter, I'm not expected to copy this. Okay, I will now highlight this. I will highlight it. Then I will come over to the data tab. Then I scroll to what if analysis and click on data table. Now we are looking for the gross profit, but our major focus is on the selling price per unit. And the selling price per unit is just one variable. And that's major reason why we are still working on the one input data table. But assuming we are looking, we are comparing both the units sold and that of the selling price per unit, definitely you should know that those are two variables. That's where you now use two data table. And I said that when you're working with two variables, it means that on this first row, this row input cell, the other the unit sold is going to be imputed there, and that of the selling price per unit is going to be imputed where we have the column input cell. So since we are still looking at the selling price per unit, using it to generate our gross profit, we are going to come to our column input cell and select, link it directly to the selling price per unit, which is this. Then we say enter. Then we say okay. So you can see right here, ladies and gentlemen, that assuming we say let's also do a search to generate that of for our gross profit, you can see that this is what our gross profit would have been. Okay, so I can come here and change the color of this. I say let this was our net profit. So I say net profit for easier understandability. Then we say this is our gross profit. Welcome, Sir Israel. Welcome. Okay, yeah, Sir Israel, welcome, sir. We are just rounding up this section for our Excel student. Okay, so after we'll continue with your QuickBooks. Okay, so at Elizabeth, hope you understood what I just explained now. Hello. So you can see that this is for our gross profit. So if selling price was at 105.89, would have made this as our net profit would have been generated, and this would have been generated as our gross profit, which is same as we have. And if there was changes from it to 109.82, this will be our net profit and this will be our gross profit, and so on. So if, for example, we come down here, okay, if, for example, we come down here to where we are having production cost, let's say our production cost per unit changes to 50. Okay, we changed it to 50. Okay, you will see that it's also going to affect the whole results that we have here. You can see the results for our net profits have also reduced to 556,350, and our gross profits also dropped to 838,350. But if we take it back to the previous, you can see it's our gross profit that there is also an increase since it went, our production cost reduced, but we have our production cost increased to 50. The changes will also reflect on this very part. So one thing you need to know is that sometimes Excel is set to calculate automatically, okay, except for data tables. And what it does here is that it looks as though your data table is going to work perfectly for you. But most times, if it doesn't work, you just need to try. You can hit on F9, okay, or to recalculate the entire worksheet. And then you can always adjust, it to ensure that everything works perfectly for you. So don't forget that this is just one input data table where you have to build it to ensure that you are able to build a dynamic financial statement model so you can be able to predict, okay, the future for the business or for your business. And your model has to be constructed so you can be able to derive the necessary information that you require. And instead of presenting to your clients that the answer to the question will be this to this, it's going to, that's instead of you presenting to your client that the answer to the question is just going to be this alone, which is not expected to be done that way. So instead of doing that, it will make more sense to present a range of different possibilities, as you can see here, that depend on sensitizing certain assumptions in this model. And that's the major reason what we're trying to look into. So just a summary. The summary is just that if our selling price was 1114.22, our net profit will be 681,300. If the same way it was this, our net profit will be what? 963,000. Our gross profit will be 960. Okay, I believe you can all still see my screen. Hello? Okay, so don't forget what I said. Please don't forget what I said. Let me share the whole screen so you can see it perfectly. Okay, so don't forget what I said, that instead of presenting to your clients that the answer is just going to be a specific answer, that it makes more sense to present a range of possibilities that depend on synthesizing certain assumptions in the model. So I believe that's clear. Okay, so moving forward, I believe you love this interpretation here. Okay, what you have been able to do. And don't forget, I said that the sensitivity analysis is also what is called the what if analysis too, because you can always get it from the data tab, and you can see right here what is being called is what if analysis. That's where you go and select the data table, and we're able to look into the scenario, and we're also able to look into the goal seek, okay, where we're able to work on that, and we're able to look into those very critical aspects. And I said that it's important you understand this because it allows you as the accountant to see what the desired result of the financial model would be under different circumstances. And right here are presented different circumstances like when selling price is 111.23. This will be our net profit. This will be our gross profit. And I said, if you come down here and say that, let's assume our production cost per unit, we reduce our production cost per unit to 48.05. What's going to happen? There's going to be an increase in our net profit and an increase in our gross profit. This way, the whole sales have been linked up together, and this makes you, come up with a very good information here. So this, what we just did here, is just one variable. What we did here is just one variable. And why is it one variable? It's because we only analyzed the selling price. So since we analyze the selling price, this becomes just a variable on its own. And I say, whenever you're working with one variable, when you go to the data table, you're to put that one variable under column input cell whenever you're analyzing using just a variable. But when it's two variable, you put it here, and you can only analyze for two variables. So now we're going to take the last example where we'll be analyzing for two variables, the selling price and the unit sold. Okay, so take note of that, because this is interesting. It allows you to select two variables or two assumptions in the same model, so you can be able to see how a desired output, such as you being able to combine the unit sold and that of the selling price, which will still use the net profit in this very scenario. And I told you that it is a perfect complement to that of the scenario manager. And in fact, it's not unusual for a client to never even look at a financial model and option to see the results presented in a data table format along with this income statement financial data that we have here. And this is why it's important for you as an analyst to understand the mechanics, or what is involved when creating a data table, and be able to interpret its results to make sure that the analysis is working perfectly. So let's look into the two input data table in the next 3 minutes, and we are done. So now let me come down here. Okay, we are done with this, just one input. Now let's say we are looking at two inputs, which we are using two variables, selling price and units sold. So I will just copy this. Let me just copy this selling price. We need it. So I can just come down here. Let me see. I just want this to be bright for us. Okay, I can come down here and say this is it. Let me just keep it here. This is our selling price. Okay, this is our selling price. Then let me say this is our unit sold. This is our unit sold. Okay, these are units sold. So for our unit sold, I will remove it from here. Okay, our unit sold. Now let's assume we were given that 15,000 units was sold. Now let's say this was 15,000 units. Okay, this was 15,000 units. Let me bring the units sold up. Let me bring it here. Let me say this is our units sold. We said 15,000. We say when 20,000 units is sold, or when 18,000 units is sold, when 20,000 units is sold, and let's just say when 25,000 units is sold. Let's stop here. Okay, so now we are comparing between selling price and units sold. These are two variables. So therefore, what you use to carry out such sensitivity analysis is known as the two input data table. So what do we do here? So we are also still going to work based on the net profit. We want to know if 15,000 units of the product was sold at this selling price, what will be the net profits? What will be the net profits? So for that reason, I will come to the selling price section. I say equal to, I bring down the net profits, and I say enter. Okay, these are net profits. I hope you're with me. These are net profits. So once I've done this for our net profits, I'm then going to do what? I will then highlight. I will highlight the whole box. I will go to my data table, my data tab, move directly to where we have what if analysis, the data table. Then right here on the data table, I'm asked same question. Now, what will be our row input cell? Since we are analyzing two variables, the unit sold and the selling price. So for the row input cell, I'm going to impute the units sold. So I will scroll and you can see our units sold. So I say enter. Then for the column input cell, I'm going to impute the second variable, which is our selling price per unit. And I say what? Enter. So once I'm done with this, I will then click OK. So ladies and gentlemen, you can see right here a very good interpretation, okay, that when is our selling price column, selling price, I put selling price, our selling price. So for those of you who do not really get it, watch the video and you will understand what we are doing properly. So you can see right here, we have the selling price column linked to. So this interpretation now is that if we sell 15,000 units of the product, we are going to make how much? At this price, we are going to make a net profit. Notice our net profits of 585,600. Now, if 15,000 was sold at a selling price of 109.82, this will be our net profits. Now, if 15,000 units sold at this price, selling price, this will be our net profits. If 18,000 units was sold at same price, same selling price of 105.89, our net profit will increase from 585,600 to 759,120. At Elizabeth, I believe you can hear me. So, like I said, being able to present your data format in this way, this is very important for you as an analyst to understand this, because it makes it easier for you to present, to ensure that your presentation is clear. Okay. And you know, we know that one of the characteristics of a financial statement is understandability. And I urge you, you know, to practice using any kind of financial model. And you know, a financial model is a great way to assess the performance of a business on both the historical and the projected basis, as it provides a way for you as an analyst to organize the business operations and analyze the results in this format. So this is an example of the two input data table, which looks into two variables: units sold, selling price, and you can see it right here as we have it. So if, for example, like I said, if there was an increase in our that of our production cost per unit, it's also going to affect the entire table. And you can see at 18,000 units sold, our net profit is going to decrease. Same way we can say we want to look into, instead of comparing it based on net profit, we want to compare it based on the gross profits. And we'll also be able to get what our gross profit will actually be if 15,000 units was sold. And let's take our production cost per unit back to the exact amount it was before, which was 48.05. You see that if we are comparing now based on gross profits, if 15,000 units was sold at this, our gross profit will be 87,600. If 20,000 units was sold, our gross profit will also what? Increase. So this way, you have been able to carry out this sensitive analysis. So this is where we are going to stop for today. There we are going to stop.